Good afternoon, friends. My name is Chandrasekhar. I happen to be the economic advisor to the IMC Chamber of Commerce and Industry. I'm also an independent member of the SEBI CDAC. I am a student of the commodities market, and through the IMC, we do a number of training programs and awareness programs on commodities. IMC is a 116-year-old Chamber of Commerce in this country. It's contributed to creation of wealth in this country. It's contributed to not only the financial capital, but also the intellectual capital of this country over the last century. And it continues to play a pioneering role. IMC works through a number of expert committees, and recommendations from the expert committees and policy inputs are all sent to the policy makers, the government of India, state government, etc. MCX, as all of us know, is India's leading commodity derivatives exchange. My own association with MCX goes back from the days of its inception. I must mention, I did the first 4 road shows when MCX was launched. Okay, but that's okay. That was 2002, 2003. I mean, that's the kind of a very old association that I have with MCX. IMC and MCX came together several years ago, probably 2016 or 2017. We have actually signed an MOU that we will continue to conduct awareness, education, and training programs on commodity derivatives, risk management, etc. And in that context, we have conducted over the last few years numerous programs. Earlier we used to do in-person events, but after the pandemic, obviously, we are still yet to get out of that virtual event mode. So this is one of the virtual events that we are doing, which is fine, and I'm sure. Arti, no cross talk, or you mute yourself. Okay, all right. Okay, and therefore, yes, and IMC and MCX have a long relationship, very strong relationship, and this is an ongoing relationship. We actually conceived this idea of commodity market fundamental forum about 6 or 7 years ago, and where we cover MCX related commodities from a fundamental perspective: energy products, base metals, precious metals, and agriculture. And today's event is on agriculture. And there are 2 key agriculture commodities that are traded on MCX platform. One is cotton, the other one is palm oil. Although palm oil contract is currently, well, suspended for whatever reason. But we will continue to conduct our awareness and training programs. And therefore, this event is a part of that ongoing exercise and ongoing relationship between these 2 institutions. I must mention, IMC is a SEBI accredited training institution for commodity derivatives. This is the only chamber of commerce in India with this distinction. There's no other chamber which has this distinction. And therefore, we want to use this to spread more awareness, education, and training as far as commodity market risk management is concerned. Let us get started. I'll make a brief presentation on the fundamentals of the cotton market and the fundamentals of palm oil market. Set the ball rolling. I have 3 or 4 or 5 slides to show, and then I'll invite India's best-known commodity expert, Rajni Panikar, to speak, give her comments and her views on cotton market fundamentals and palm oil market fundamentals. Rajni, I will not reveal her age, but she's an old hand in the commodity space, and she's very well known. She's a fantastic researcher, and therefore we'll have the benefit of her domain expertise. Then, of course, I think between Jagan and Abhishek, they can choose who wants to be number 3, and then we'll take it forward from there. we will reserve the last 15 minutes for Q&A. Okay, and those who have questions, please use the chat mode to post your questions, right? Okay, and therefore let's get going. Just give me a moment. I need to share screen. Where is my screen? Yes, here it goes. Share. Hey, awesome. Slideshow. Okay, from the beginning. All right, is it clear? Is it visible? Is it clear? Is it visible?
Yes, sir. Yeah.
That is all I want. Yes. Okay. So this is IMC MCX webinar, Commodity Fundamental Forum, and our focus today is cotton and palm oil, and both are so critical. By the way, from Saturday, today is Monday, right? Saturday, Sunday, Monday, and until tomorrow and day after, the International Cotton Advisory Committee is actually meeting in Bombay. After 2015 was the last meeting, plenary meeting of ICAC, which is an intergovernmental body. And I had the pleasure of, I had a speaking slot yesterday in a panel on that international convention. So, let me now straight away look at market outlook, first half 2024. Okay. All right, let me go. These are the numbers as far as cotton is concerned. Look at the trends in the last 2 years. Let us focus on 23-24 global production. All these numbers these are in tons. Okay, these are in tons. 24.9 million tons of production, and if you want to convert into Indian bales, probably the thumb rule is multiply by 6, and you will at least get a ballpark number in bales. Okay. With an opening stock of 21.2, we had a production of 24.9. The consumption for projected for 23-24 is only 23.9, which is 1 million bales extra production. Okay, and you compare that with the previous year, it is virtually the same. Again, just about 1 million bales consumption trails production. Okay, and therefore there is a huge closing stock which is going to be available, and that in my view is going to be a little burdensome for the market. The world market S&D, based on these numbers, S&D is reasonably comfortable. Therefore supplies are not likely to be an issue, but demand concerns may emerge. All said and done, China is already slowing down. US, there are incipient signals of US entering that slowdown phase. And obviously, even one can expect in the second quarter of 2024, there'll be huge pressure on the Fed to start the first round of rate cut. Okay? Therefore, there's no question of rate hike anymore. There's only a question of rate cut, probably in the second quarter of 2024. Look at ICE futures down about 2% year to date. Okay, that's the kind of pressure the cotton market has been so far. What is likely to happen in 2024? Obviously, these fundamental numbers will play out, but we also have experts like Jagan and Rajni to tell us what is likely to happen in the first half of 24. Let's look at very closely Indian numbers. 30.1 million is the first number that came out, but actually there's a huge loss because of pink bollworm in states like Punjab. In fact, even this 29 million bales, I think now is somewhat overstated, and it could be even lower. It could be 28 million, it could be even 27 million. Okay, and therefore that is Indian availability is a matter of concern. Okay, the second one is the consumption. Consumption will continue to rise in India over the next 7 or 8 years. I projected that our consumption demand will reach easily 38 million bales by 2030. Whether we'll be able to produce 38 million bale by that time is another question, another discussion for another day. But the point is, this year there is going to be a mismatch between domestic production and domestic demand, and the demand is going to stay higher. Probably, I would think 2.5 million bales at least. Okay, so production is going to be lower, demand is going to be higher by that amount. I'm just giving kind of ballpark numbers. Our export possibilities are about 1.5 million bales, but our imports after so many years are going to exceed our exports. I am projecting imports at about 2 million bales. Again, our experts, I'm sure, will have their comments and will have their own numbers with enough justification. Our demand is growing and will continue to grow. Although any recession in the West is likely to affect our textile exports, and yet our domestic demand, in my view, should perform quite decently, should grow quite decently. A lot of new spindles have been added, and they are continually being added, so that's going to generate a demand. So demand side is quite robust, but there are problems with the supply side. So this is overall on cotton. If I can turn to palm oil again, okay. I find in the last 1 month, 2 months, there has been a lot of hype about crude palm oil shortage in 23-24. I would think those participants who are here, who trade CPO, should exercise some caution. Again, I want to give some fundamental numbers. There's a record global oilseed harvest, 661 million tons, up very sharply from the previous year. I'm so sorry. Of which soybean production is going to reach 400 million tons, up at least 28 million tons from last year. Sunseed harvest is going to be 57 million tons, up probably 4.5 million tons from last year. Major vegetable oil production is going to hit a new high, 223 million tons. Even palm oil production is going to rise by at least 2 million tons to 79.5 million tons. Overall vegetable oil production is going to overall vegetable oil consumption use is going to trail production by at least 4 million tons, notwithstanding diversion for biodiesel, Indonesia talking about B30, etc., etc. So these are the fundamental numbers that I want to present. Coming specifically to palm oil, I find Indonesia, I have reason to believe, will produce 47 million tons of palm oil, 1 million tons higher. Malaysia will produce 19 million tons, 500,000 tons more. Others, Thailand and Ivory Coast and other countries together produce 13.5 million tons. El Nino effect, yes, El Nino is very real, and we have seen in our country the effect of El Nino. El Nino in Southeast Asia certainly hurts oil palm plantations, but it has a lagged effect. It has a 2 or 3 quarter lag before the El Nino dry conditions manifest themselves in or convert themselves into palm oil production. But El Nino this year, at the moment, I believe, is actually fading. And it's certainly not as severe as it was in 2015-16. For example, I'm sure many of us have lived through those times. You know what happened in 2015-16. But so it's not as severe as that. And it's now started to fade. Although we know in India, it's still going to continue well into March and April. And we will witness the effect of that in Rabi production. But anyway, that's another conversation altogether. And therefore, El Nino is real, but its effect is fading. Also, seasonally, Jan, Feb, March, always palm oil prices tend to rise. because that is a lean season. Peak production season is from April to October, April to November. So that is the time prices tend to firm, and therefore there is nothing unusual that if CPO prices start to rise in Jan, Feb, March. But at the same time, winter months, November, December, Jan, Feb, palm oil demand actually declines because it solidifies during the winter season, and then therefore the demand is less than normal. Another factor that impacts CPO is, of course, the via the biodiesel route. There's a lot of diversion of CPO for biodiesel purposes, but that will again has a relationship with crude oil prices. There are some countries like Indonesia where it is mandatory. There's a mandatory level of blending with diesel. But there are countries which also follow some voluntary blending guidelines. For if crude oil prices were to remain at a more affordable levels, then the demand for CPO for biodiesel purposes will also not grow. Okay, all right. OPEC recently decided that it'll continue its production cut. But we find in the market it is, at least until now, the impact is quite limited. So to what extent OPEC Plus decision to cut production will have impact on CPO, I think we need to wait and watch. But I think the impact will be reasonably muted, right? And then look at your Malaysian derivatives exchange. Okay, Bursa Malaysia. CPO prices are down 10.5% year to date. Okay, I remember probably March or April, I was on a television show along with one of the world's most renowned experts. He was giving an absolutely bullish forecast, and I wasn't ready to accept that. Therefore, I countered with my forecast, and you know what happened in the market. You know how prices crash. You know how edible oil companies have lost money in 2023. And therefore, I think we've got to be careful. People will always try and create a bullish fervor, but the numbers are what are important. We need to look at the numbers, and then therefore, I think you need to exercise caution. So I will stop here. I probably exhausted my 10 or 12 minutes already. I want to just say two things. One, I think it's a matter of honor that our Sudhir Kumar Goel Saab has joined this event, and that shows this enormous and extraordinary interest in agriculture, particularly in cotton. Goel Saab, welcome. And one more, my old young friend Kishore Tanna is also here. Is joined. I saw his name. Kishore, welcome. Such a pleasure to see you. So with this, I'll say good luck. God bless you all. I want to issue a disclaimer, which I do all the time. I am not a trader. I don't hold any trading position, either in the physical market or in the derivatives market. I'm a student of the market. I learn all the time, and I teach most of the time. This is it. Plus, there is a disclaimer which is mandatory, which is what we are showing you on the screen. Bharti, thank you for showing this. This is very important. And the views expressed here are views from those who follow the market, who have some knowledge, but don't be guided by these numbers, or don't take trading positions based on these numbers, because the markets keep evolving all the time. Okay? And therefore, it is extremely important that you also do your own research and come to your own conclusion. We are not making any price recommendation. We are not making any price forecast. It's very, very clear. Let's be very clear about that. Okay, so with this, let me say good luck. God bless you all. Take care. Of course, I'll continue. And let me now invite Rajni Panikar for her presentation, or for her request her to share her thoughts.
Good evening to all participants, and thank you so much, Chandrasekhar sir, for this opportunity as always. Just give me a moment to share my screen. Is my screen visible now? Okay.
Rajni, people are waiting with bated breath. What is
Yes,
Rajni?
ma'am.
Okay.
Sir, I have no such presentation for which any bated breath is required. It is a very simple analysis of where the market is in cotton and palm oil, and I think you've covered most of the ground. I think I just have a few more slides to show in palm oil, where I have given the fact that there is a suspension currently underway. So I have given a broader outlook on what India's dependence on edible oil imports has been and where palm oil plays a role. So that's where I think that I'll digress a bit from writing the topic given to me, but I thought that that would also add value to the participants. So I've taken that liberty. I hope it's okay.
For sure.
So just a quick introduction on Phillip Capital. We are a financial services firm which is headquartered out of Singapore and has presence in about 15 countries. Therefore, in India, we have been present on the MCX as financial intermediaries. As in, if you want to trade any of the MCX products, then you'll need an intermediary, for which Phillip Capital has been present right from the inception. And we've known Chandrasekhar sir from his days of roadshow to how the markets pan out right now. So that's a good 20 plus years, 2 decades long journey. Phillip Capital provides access to most of the derivatives, commodity contracts in India, as well as equity contracts. Also, as we are headquartered out of Singapore, we have memberships on all major commodity exchanges globally. So we are also members of ICE, which is a benchmark for cotton for most Indian participants, like it is for all global participants. And for BMD, the Malaysia exchange, which is called BMD, we are also members on that exchange. Not only can we provide access to locally traded commodity derivatives, but given our global presence, we can do that for global exchanges as well. That's a quick introduction of Phillip Capital for people who don't know us. Now, to jump to the topic at hand, the groundwork has already been laid for by Chandrasekhar sir. So if I quickly go to what we have to share. So we have taken an Indian cotton balance sheet, which is a combination of what Cotton Association of India is saying, as well as our internal research. So we are of the view that the production is going to reduce year on year by about 24%. Imports are going to marginally increase, given the fact that the shortages could lead to a price hike and therefore an import parity, due to which the supply, however, could remain pressured because the imports will, of course, be far less than the production decline. So we are looking at a 295 lakh bale production currently, which is our first of estimates along with the CIA, compared to 318 lakh last year. On the consumption front, we are not seeing too much optimism. That is the speaker from our windmills will be able to throw much more light on this. But our pulse of the market says that the consumption demand from mills is going to be flat. From mills. And therefore, that despite the fact that there is a production decline, given that there is subdued consumption, the price spike may not be very high, or may not see a rally as is seen during low production years. Our exports, given the fact that we might not have the export parity, is also estimated to be about 14 lakh bales, which is lower than last year. Our closing stocks will decline, which is subject to the fact that there has been lower production. Given these kind of numbers, when we put the demand and supply together, our view is that fundamentally domestic prices could consolidate in the season ahead. Now, when we look at world production and supply, we've taken million bales to compare the numbers. And we've done this interesting study in the sense that we want to look at the production numbers, which is around 113 million bales this year that is forecasted. Consumption is estimated at 115 million bales. So we have production which has declined 2% year on year, but consumption has declined 1%. So though this is price supportive because production is declining more than consumption, but what we want to point out here is that when you look at the consumption number of 115 million bales, then it is still lower than pre-COVID levels. This is the function of the fact that most major economies are under a recessionary spell, given the monetary tightening that we have seen over the last 1.5 years. As has been pointed out by Chandrasekhar sir as well, China, the largest consumer, is witnessing uneven growth and therefore weighs on demand for cotton. Interestingly, the US presidential election and with Trump leading that race, we see that if any probability of Trump coming back to power has resulted in huge tumultuous relationship between China and US in terms of trade. And forecasting such a scenario to play out again could be again bearish for cotton. So, the world's cotton supply and production, if we have to summarize, we are talking about a weak consumption outlook, concerns over recession, US presidential elections. All this is likely to keep any check on any sharp increase in prices despite the decline in production. A similar scenario as we are seeing in India is more or less mirroring in the world supply and demand analysis as well. Now, when we come to the cotton price moves, we have plotted here on this chart the 2022 to 2023 season, which is the October till September, and then the October and the November. Now, if you see over this period, the ICE cotton, which is the one in blue, and it is on the left-hand side of the screen, the price chart, it has been on a broad range of 71 cents to about 89 cents. And has continued to remain in that particular range even in this current season, as in October and November of this year. MCX prices, on the other hand, was at 72,000, around 72,000 levels, which had come down to about 55,000, largely mirroring the arrivals in supply, which we take in the next slide. What we have seen is that unlike last season, when the first half arrivals were not as strong, in this current season, starting from October to November, the cumulative arrivals have been about 55 to 56 lakh bales, which is about 9% higher on the previous year. And this along with the fact that our export interest is waning, has resulted in something which is very closely monitored by the industry participants, which is the ICE and the MCX premium. So in this chart, we have taken MCX also in cents per pound, and we can see that from last year, when the MCX premium was really about 35 cents over ICE, currently they are trailing at about 5 cents. So despite the fact of lower production, we are definitely seeing on price an impact of falling demand and falling export scenario. Which then therefore brings us, I hope it's okay for us to give the price outlook. You mentioned that we are not supposed to talk about price, but can I just give a view, Chandrasekhar sir? Is it okay?
I request Rajni, please skip this, please. I'm sorry.
Oh, okay, no, not an issue. Sorry.
I don't want.
Yeah, not an issue.
Yeah, please. Sorry.
I thought I saw price outlook in the agenda, so it's okay. No, we can just quickly. So our view is that
market outlook where the market is heading.
Oh, yeah. Sorry, my bad. So overall, what we would like to summarize for cotton is, I'll go back to this chart, is both on the domestic as well as the international scenarios, consumption remains a concern. And given that consumption remains a concern, despite falling production, both globally as well as the same scenario in India, we are not seeing too much of price spikes expected, both in terms of both in terms of ICE prices as well as MCX prices. That is where I would like to leave my cotton presentation at. Coming quickly to palm oil, I thought that since there is, like I said, the current contract on MCX is suspended, for the benefit of the participants, I wanted to give a few interesting facts about India's edible oil supply and consumption. So for the unawares, this might be interesting that India had a consumption of edible oil of about 24 to 25 million tons annually, whereas the domestic edible oil production has been about 11 to 10.5 million tons. And though consumption has been increasing steadily at the rate of 2 to 4% annually, the domestic edible oil production has remained stable around these levels of 9.5 to say 10.5 and maybe upwards of 11 million tons. But that's how it has been for a decade or so more. Therefore, this gap between the consumption requirement and the supply gets filled in by imports. And it might be surprising to the people who are unaware that Indian edible oil imports, that India depends on edible oil imports to cover 65% of the supply, and therefore the demand of the deficit in the production that happens for edible oil is met by imports, and that covers 65%. So that puts us in a very precarious situation to any kind of price spikes in international markets, because our import dependence is as high as 65% to meet our requirements. And for that, we pay a huge bill. It is estimated around $18 billion to pay for our edible oil imports, second or third largest after gold and crude oil. And we are also, therefore, the world's third largest consumer in the world, with such a high dependence on imports, making our situation very precarious. Of this, palm oil, interestingly, accounts for 60% of the import basket. And therefore, the importance of palm oil, whether in terms of maintaining our food security or in terms of the importance of palm oil in the edible oil basket to measure our inflation, palm oil, therefore, is very closely monitored for the importance that it plays in our import basket. And another trivia is that over the last 20 years, our edible oil import volume has increased nearly 3 times. But what is painful is the fact that the cost of the imports has gone up nearly 17 times. When we look at how the Indian veg oil imports, as we've just explained, that India has a deficit to meet its demand by internal production, and therefore our reliance on imports. So the way we are currently positioned is that for the oil year, which begins from November and ends in October. So for the year that ended in October 2023, we have imported 16.5 million metric tons, which has increased from about 14 million tons last year. Indonesia and Malaysia are our largest suppliers of palm oil. And into 2022-23, we have imported 9.9 million tons, of which 7.5 is the crude palm oil, the unprocessed palm oil, and the remaining is olein, which is a refined product. And this has largely been because of the fact that Indian demand for edible oil has gone up because of lower prices. Also, there has been parity in terms of importing palm oil and selling it domestically has resulted in positive parity, which is what has resulted in this huge increase in demand. And the remaining oil basket, or the edible oil basket, is covered by soft oils, which is sunflower oil and soy oil, which comprises 47% of our import basket. So it's, of course, very, very clear that palm oil is the most important edible oil in our import basket. And given that the fact that we have a huge reliance on imports, and certain projections that show, we also thought that it would be interesting to look at the Solvent Extractors Association's projection on edible oil imports, which goes all the way till 2029 to 2030. So currently, if our edible oil consumption at a 3% annual growth for consumption is around 24.7 million tons, and at a 4% growth is about closer to 25 million tons. It is projected that by in 2030, this demand for edible oils will go up to 30 million tons to 32 million tons. Now, the concerning factor here is that though projection of demand remains very robust, the oilseed production growth is expected to grow to only about 45 to 48 million tons, which currently about 34 million tons. And the overall availability of domestic vegetable oils is going to be only 15 to 16 million tons. This is a huge gap. Our demand for edible oils, 30 to 32 million tons. By 2030, our local production could only be 15 to 16 million tons. And therefore, the supply gap is going to be bridged by imports. That's how the scenario stands now. And given that we are already at $18 billion of import bill, this is a concerning situation for the government. And currently, where we stand for palm oil is that our domestic production, compared to 2016-17, when it was about 2 lakh metric tons, is about 3.3 lakh metric tons. Not much compared to the fact that we import 7.5 million tons of crude palm oil and another 2.4 million tons of refined. So compared to nearly 10 million tons of imports, we are producing just 3 lakh metric tons. So I'm sure sleepless nights for powers in the government to manage the import bill, which is forecasted also to increase. So therefore, for palm oil specifically, the government in 2021 launched a national mission on edible oils, very ambitious targets. It is looking to increase the crude palm oil production to 11 lakh tons, which is currently 3 lakh tons by 25-26. And to about 28 lakh tons or 2.8 million tons by 2029-2030. The reason, once again, that palm oil is given this push is because of the fact that palm oil has one of the highest yields per hectare. So the average yield of a palm oil tree is about 1.9 to 4.8 tons, 1,900 kgs to 4,800 kgs per hectare, which is nearly like 2 to 8 times of the more traditional oilseed growing crops like mustard, soybean, groundnut. So it is very evident why government wants to push palm oil. It has given huge financial incentives also, allocations in the budget to increase palm oil. So fingers crossed, the demand scenario looks robust, the consumption does not, and therefore we need this palm oil mission to find foot so that we can have a control over our edible oil import bill. The challenges, of course, on achieving these targets are that palm oil has multiple sustainable standards which is developed by other countries. India has also signed these agreements with Malaysia and Indonesia, but it is very important that these awareness of sustainability flows into business and consumers. If that doesn't happen, then despite the government efforts, we have to meet the sustainability standard protocols for our production to be viable. So that remains a big challenge. And another factor is that when it comes to edible oil, because it's an essential commodity, it's a consumer, the consumer demand is very price sensitive. So if we have a scenario where our domestic palm oil production increases, but given economies of scale and the larger production boys, which is Malaysia and Indonesia, continue to produce what they are producing, and they are 85% of global production, and they are just by economies of scale, their palm oil is cheaper, and our import duties are not tweaked so that these cheaper imports don't land into India. We might still remain dependent on edible oil imports despite a growing palm oil production. But it will still be a happy scenario to be in, because once we achieve this sustainability of local production of oilseeds or palm oil increasing, finding a way to perhaps keep prices under control is something that the government can still do, given the fact that we have absolutely flat oilseed production and an ever-increasing import bill for edible oils. So that is something that the government is trying to avoid, and therefore has these missions in place, and we will just have to monitor how they play out for palm oil local supply. Again, the next slide, I thought that given that Malaysian palm oil production, the BMT exchange, the next slide was on the price forecast, which I'm going to not cover, but the importance of Malaysia, Indonesia palm oil production, and I think the overall palm oil global S&D as they stand has been covered by Chandrasekhar sir. I thought that this trend also has to where India stands in terms of its sustainability for edible oils is what I thought I'd cover to add some value to our participants. I hope it did meet the requirements. This again is our contact details. Please feel free to reach out for any further discussion. Of course, other than in the Q&A, if there is access that is required for any kind of corporate price hedging, we'd be happy to provide access both to MCX and our global exchanges that we do cover. Thank you so much.
Thank you, Rajni. As always, absolutely focused on the dot, and certainly you touched the fundamentals, especially in case of cotton, and gave a fantastic overview of the palm oil situation and how critical it is for India. Thank you very much. Very interesting, I think very informative, I'm sure, for all the participants. Now I'm debating between Abhishek and Jagan. Have you decided, or let me invite Jagan to say, Jagan, would you be?
Yes, sir. I can go first because Abhishek probably would want to talk about CPO as well. So let me first complete the cotton bit of it.
Yeah, okay, that's right, exactly. Very nice. Please welcome. Yeah.
Thank you, sir, and good afternoon, Chandrasekhar sir and the organizers of the event. It's always a pleasure to be part of such groups and share views. And I strongly believe that with such exchange of information and knowledge is the collectively, the knowledge level of the country and the various associations goes up. To give a small introduction of myself, I am Jagan Gopinath. I am heading the cotton sourcing department of Aravind Limited, and Aravind is one of the largest integrated textile firms in the world and one of the largest denim manufacturers in the world. I am based out of Ahmedabad, which is the head office of Aravind. I also represent India in the International Cotton Association based out of Liverpool in their board of directors. I am the associate director representing India. Now, coming back to cotton, I think Chandrasekhar sir and Rajni madam, they spoke in length about their views about the market and the fundamental figures. Before I go into the figures, I just want to give an overall perspective of how price discovery happens in cotton, because there will be many in this group who are fresh to this whole topic. So cotton is not just an industrial raw material. It is also considered today as a financial asset class for investment. And that makes the dynamics of cotton and the price discovery in cotton very interesting. Many times we find that the cotton futures market is trading completely different from the fundamentals of the physical trade on the cotton side, completely divorced from what is really happening to supply and demand. And therefore, it is important for us to understand the nature of the participants in the futures market, especially the ICE cotton futures market. Now, there are basically four kinds of participants in the futures market. One is what we call as the producer, the user, and the merchant category. So this category comprises of all the spinning mills in the world and all the multinational companies who are trading cotton from around the world. Most of the times, this producer, user, merchant category is on the short side of the futures. Why? Because they are the people who handle cotton on the physical side. So most of the times they are long on physical side, and then they need to hedge their exposure, and therefore they short the future. So today also, if you look at the breakup of the open interest, you will find that net short position is being managed by the producer, user, merchant category. Then comes the category called the swap dealers. Swap dealers, a prominent example of a swap dealer is somebody like a Goldman Sachs Commodity Index Fund. Now they are passive investors. They have a different charter of operations, and they basically are, most of the times they are on the long side, because many times they use cotton as a investment in cotton as a hedge against inflation. The third category is the managed money funds. Now, the managed money funds are the ones who bring a lot of volatility into the cotton futures and options market. Why? Because they are very opportunistic in their behavior. In the month of October, they were heavily net long in ICE cotton futures, but since the beginning of October till date, they have actually switched their position from net long to net short. They went net short almost 6,000 contracts, and now they are almost running a squared off position. And then there are the other reportables and the non-reportables. So this is the category of the participants or the profile of the participants on the futures side. Futures market plays a very important role in terms of signaling the pricing to the physical side, because ultimately, even when the futures market can trade very differently from the dynamics of the physical market, but especially towards the expiry of a futures contract, there is a convergence between the physical market and the futures market that most of the times happen. So this is the broad background. Now, when you look at the world supply and demand estimates in cotton, one prominent number that we have to look at is the forecasted consumption of 115 million bales. So that is the consumption figure that is forecasted by the USDA. Now, these are million bales of 480 pounds net weight. Chandrasekhar sir spoke about million tons, but I am using the million bales number as given by USDA. Now, this 115 million bales, if I look at the breakup of it, almost 78 million bales is supposed to be consumed by world outside China, and almost 37.5 million bales is supposed to be consumed by China itself. Now, both these figures seem to be inflated for me. China, we have seen continuous deterioration in the industrial production numbers, in the manufacturing indices. The manufacturing sector and the textile manufacturing is also contracting in China. And the non-manufacturing sector, the growth of it has slowed down in China. Plus, there are a lot of property, real estate sector issues in China as well. So this number seems to be inflated. And therefore, with this 115.3 million bales of consumption forecast, USDA has projected an ending stock of 81.5 million bales. Now, since we believe that the consumption forecast is inflated to the tune of almost 2 to 3 million bales, I believe that by the end of the marketing year, there will be an extra 2 to 3 million bales that will get added on to the ending stock of 81.5, and that should take us to comfortable terrain. This is point number one. Point number two that we need to look at is that the US futures exchange is the most liquid futures exchange for cotton in the world. Of course, the ZCE exchange in China is also another prominent exchange. Now, since US futures is used for the price discovery mechanism, anything that happens to the supply and demand situation in United States has a bearing on the physical cotton prices in the rest of the world. It's quite natural, right? Because if whatever the benchmark signals, that signal will get reflected all across the world. Now, when you look at the US forecasted numbers, USDA has forecasted that US this year, this marketing season will export 12.2 million bales. And out of that, so far, they have sold 7.8 million bales, and they are yet to sell the balance. This is point number one. But if you look at the breakup of the 7.8 million bales that they have already sold, you will find that they have sold 1.29 million bales to Pakistan, but they have shipped out only 0.2 million bales out of that. They have sold 0.49 million bales to Turkey, but they have shipped out only 0.07 million bales to Turkey, and plus Bangladesh also. Now look at what is happening to the currencies in these respective countries. Turkish lira on the 5th of December 2022 was 18.63. Today, the Turkish lira is 28.92. So that represents a huge risk to whoever has sold cotton to Turkey, because their currency has significantly depreciated over the last 1 year, especially so in the last 6 months. So there is a possibility that going forward, some of the contracts that are in the books of the multinationals towards Turkey, it might get reversed and these positions might come back to the futures market. So this is one issue. Bangladesh, the taka, the currency of Bangladesh has depreciated from 86.66 in April 2022 to 110.28 in the 3rd December 23. Significant depreciation. The Pak rupee depreciated from 224 in April 22 to 308 rupees to $1 in September, and then it has strengthened back to 285. So this strengthening of the US dollar index due to that narrative of inflation remaining strong and the Fed likely to increase the interest rate, that narrative has really weakened the currencies of lot many importing countries. And there is a possibility that some of those contracts might get sold back by the mills back to the merchants, and it might come back to the board again for hedging. And that represents an issue to the board. Coming back to the Indian balance sheet, I have a difference of opinion to the figures that were discussed earlier. For example, the Cotton Association of India has forecasted 295 lakh bales as the production in India. But the ministry, the central government has forecasted 316 lakh bales as the total crop. And based on our private surveys, we believe that the actual production figures are likely to be closer to the ministry figures than to the Cotton Association of India. Second, there is a divergence between the ministry's forecast of or ministry's estimate of the opening stock and the Cotton Association of India's estimate of the opening stock. Cotton Association of India is talking about 28.9 lakh bales as the opening stock, whereas the ministry is talking about 64.08 lakh bales as the opening stock. We believe that the opening stock is somewhere close to 40, but then please do not trade the market based on the figures that I am giving you. These are just private estimates. So, considering that CAI has forecasted an ending stock of close to 20 lakh bales, that represents, if you take that figure as closer to reality, then there could be an uplift in the prices. But since I and many in the market do not consider that ending stock will be that low, because we have a much lower estimate of the consumption. So most of the official agencies are talking about a consumption in the range of about 310 lakh bales. I strongly believe that the consumption is likely to end up between 295 to 300. So net, I am looking at an ending stock of around 45 lakh bales compared to the ministry's forecast of 57 lakh bales and compared to the CAI forecast of 20 lakh bales. Now, it is up to you, those who want to trade cotton, it is up to you to form your opinion on which number could be closer to reality and then trade accordingly. So, going forward, if I have to hazard a guess about what could be the likely trajectory of the market, again, this is not a price forecast as such, but given the dismal demand scenario, given the fact that the hike in interest rates is now biting into the real world, even though we are talking about an increasing probability for the US Fed to start reducing their interest rate from the month of May, of course, that is there, but the interest rates that were already hiked has already started biting into the prospects of the businesses around the world, and that has already reduced the consumption. So each day that the consumption remains lower than the forecast, please understand that the ending stock will get that much additional buffer. A comfort zone will start to get building up in the ending stock. For example, in Tamil Nadu, we know that almost 5 lakh spindles is closed. We know that out of the spindleage that is working in Tamil Nadu, close to 15% has switched to viscose. So these are all market share that has gone out of cotton into other commodities, into viscose and other man-made fibers. So considering all of that, I believe that this market is likely to remain range bound between now and the end of March. And as we head into the second quarter of the calendar year 2024, I believe that there could be a certain demand revival that happens. And that can happen if it coincides with a slight weakening of the dollar index from now. Because if you look at the Fed Market Watch tool, there is a 100% probability for the US Fed to reduce interest rates by 25 basis points in the month of May 2024. And the odds are also growing for a possible reduction of the interest rate probably by the month of March itself. Now, if that happens, that could lead to a certain weakening of the dollar index, which will be supportive for commodities. But then we cannot also jump into such generalized conclusions so easily, because we also have to look at the divergence and growth trajectory between the United States and the rest of the world. So just because US is going to reduce the interest rate doesn't mean that the dollar index is going to weaken. If by reducing the interest rates, if the US private sector is going to perform much better in the coming months, then it will attract a lot of money into the US equity market, and that could also attract the funds back into the dollar index. This is one point. Second, we have seen very recently that as the odds for the Fed to reduce interest rate has gone up, we have also seen that the bond market in the US has really soared. You know, the prices of bonds have gone up. Now, all of you know that the bond prices behave inversely to the bond yield. So when the bond yield starts going down, factoring in the expectation that US is likely to reduce the interest rate, there is more demand coming into the bond market, leading to the rise in prices of the bond market. Now, bond market along with the equity market, it's a huge market that can lead to fund flow. It can attract fund flow from commodities back there, because this narrative of commodities, especially cotton, as a hedge against inflation, that narrative is weakening now. The other narratives will start playing out in the coming weeks, and that could lead to money going back to dollar index. So let us not quickly jump into the conclusion that dollar index will weaken just because US is likely to reduce the interest rate. However, if if dollar index is supposed to weaken and the supply chain, there is so much a buildup of inventory on the apparel side, the fabric side, the yarn side. Now, once that inventory level starts coming down, and then the downstream users, they need to order more of yarn, and if there is more orders placed for yarn, there will be more orders placed for cotton, and this value chain will once again start picking up. So a combination of two things have to happen in the second quarter of 2024. One, the dollar index weakening, or at least dollar index remaining range bound. And second, growth picking up because of inflationary pressures coming down. And if growth picks up and if inflation comes down, it will lead to more disposable income in the hand of the global consumers, especially the US consumers. And it could lead to supporting of the textile and the apparel market. And therefore, the cotton market could also get supported. So between now, to summarize my views about the cotton market, between now and the end of or the expiry of the March cotton futures, I am expecting the market to trade between 76 and 82 cents. And once March goes off the board and the open interest will shift to the month of May, I am expecting that the trading range will shift back to 82, 86 or 87 cents. That summarizes my points. If there are any questions, I can take it now or at the end of the presentation. Thank you.
Thank you, Jagan. Awesome presentation coming from somebody who's in the thick of action and who's hands-on. I'm sure it carries a lot of credibility, a lot of weight, and a lot of consideration by market participants. Thank you very much. I think very, very interesting. Very interesting observations, especially on dollar index and on currency, etc. Very
Thank
good.
you, sir. Thank you. And I also want to share it in front of the group that when I was a student in the College of Agriculture in Trivandrum, Chandrasekhar sir was one of the people in the Indian industry whom I was always looking forward to. He used to write in Hindu and in many other publications, and some of those thought-provoking articles that you published triggered my interest, and today I have the fortune of sharing a dais with you. I mean, thank you, sir.
God bless you. God bless. Take care. Yeah. We'll meet sometime. Yes. Now let's hear Abhishek. Abhishek Govilkar handles MCX's agri portfolio, and he will share with us his perspective of cotton and palm oil. And I'm sure he's going to tell us why hedging is so important. I think Abhishek, the floor is yours.
Thank you so much, sir. And I would like to thank IMC for organizing this particular event and giving us the opportunity to explain why hedging is so critical from a business point of view, and why the commodity participants should take advantage of the derivative platform in order to manage their price risk, as well as prevent from any unwanted price movement that are happening in the commodity market. At the same time, I would also like to highlight that fact that all my previous presenters have already given quite a elaborate explanation of the fundamentals that are currently playing out in the market, and how the markets are or used to be quite a price sensitive, and will continue to remain volatile owing to demand and supply disturbance. In my presentation, first of all, I would like to just share a short video clip which MCX has prepared, which basically highlights the need and why hedging is so critical from business point of view. If the panel and the floor allows me, I will like to share that video with all. share. Is my screen visible?
Yes, sir.
Okay.
Such large export orders don't come by easily, sir. Shukla ji, last year the prices of raw material were quite volatile. I don't know what will happen this time. Oh, sir, this order is for 3 months later. Don't worry so much. But yes, we have to inform the client soon. Otherwise, we might lose the order. I'm ready to finalize the order. But for the right profits, we first need to decide at what price to purchase the raw materials. If I buy in advance, there is a risk of prices falling. And if I buy during the order processing, there is a risk of prices rising. I don't know what to do. Please suggest something, Mr. CFO. Price fluctuations keep happening. When commodity prices rise in the country, goods become more expensive for consumers. And when prices fall, farmers are affected. To avoid this, you should hedge your raw material exposure in the commodity derivatives market. What are the benefits of commodity hedging? There are many benefits. In the exchange, we can see the price of our raw materials in advance. We can determine the price for our commodities 3 months from now on the exchange. Not just that, we can also take delivery of it. Then, whether prices rise or fall in the spot market later, we don't have to worry. Now my concerns about raw material prices have been addressed. And this will make our business even stronger. Yes, and one more thing. We can set off the gains and losses from hedging against our business profits and losses. This is indeed a very beneficial deal. We are already making in India. And now with the hedge in India, we will have price in India and trade in India. Mr. CFO, please hedge the contract for 3 months. And Shuklaji, confirm this order, please. If you really want to make your business stronger and more stable, please keep hedging your commodity risk on the exchange and don't forget it.
Yeah, thank you. So this was a basic, simple presentation why all of the business as well as the market participants should come forward and manage the price risk. Now I will also have a short presentation for Okay, so basically in the agri commodity space, MCX has got mainly 3 contracts which are listed as of now. Currently, we are having contracts for cotton candy, which is a lint-based contract. Another is the raw cotton, which is kapas contract, and we also have mentha oil contract, which predominantly covers the mentha trade, which is used in confectionery as well as for medicinal purpose. Apart from that, we also used to have a crude palm oil contract, which earlier used to trade very actively, as well as was the flagship contract in the edible oil space in Indian commodity derivative markets. But due to certain compulsions, government had suspended edible oils as well as oil seeds from the derivative platform since December 21. So far, we are continuously following up with the government for the relaunch of this CPO contract. But as of now, the CPO continues to remain in this list of commodities which are suspended for the trading. In cotton, basically, as my initial video also suggested that, or even my fellow panelists also suggested that the market price behavior continues to be played on the demand and supply factors which are playing out in the inherent physical market. And no one can have a real prediction of how the prices are going to behave on a future basis. So if particularly any organization or any manufacturing company wants to do a particular sale for their produce, say 3 months or 6 months in advance, they are pretty uncertain about the actual price realization for the raw materials or even the finished good at which they are going to sell in the market. So inherently, the commodity markets are like this only, and there is a lot of uncertainty in terms of the price behavior of the market, whether it is going to rise or whether it is going to come down in days to come. So basically, at any given point of time, any particular market participant has got scenarios in which the prices may move up or down, and accordingly, their own positions in the underlying physical market or for the raw material which they intend to purchase may also get impacted because of this movement of price. So in this particular scenario, the platform like MCX do help market participant for using the contracts which are listed on the exchange platform for locking the price so that the entire variability in terms of the price behavior for the future months can be completely be taken care of, and in that way the particular organization or the people can completely isolate themselves from the adverse price movement which are happening in the physical market. So I will also explain how this particular hedging helps. So basically, if a particular person like a particular spinning manufacturers has intention to procure or do a forward sale of their end product, say in the month of June. And currently, if the prices for cotton is trading at somewhere around say 55,000 per bale, and then they have an expectation that the prices or there is a uncertainty in the market that prices may go up or down based on the demand supply, but at the same time they have a compulsion to say lock in the price or commit to their suppliers that they are willing to sell their manufactured product in the month of June at a certain price point which is profitable for them. So in this particular scenario, the spinning manufacturer can use the exchange platform for locking the price. Suppose if they have obligation to buy in the physical market in the month of May in order to fulfill the June order, so they can very well say take part and take a long side position in June May contract, so that at the time when the contracts comes toward the maturity and they try to get the material in the physical market, they can take a counter position on the exchange equivalent to the purchase that is done in the physical market and square up the position, and they can realize the whatever mark to market profits or the profit or loss which is there on the derivative contract against the underlying purchase in the physical market. So in a way, they will be completely isolated from the price movement for that commodity. So basically, in cotton, as I mentioned, our contract is this is the basic contract parameters for the cotton contract. The basis is for the Rajkot, and we do cover multiple delivery centers all across India. We are covering delivery centers across Gujarat, Maharashtra, and Telangana, as well as Madhya Pradesh. So in all total, there are 8 delivery centers through which the market can use to either tender the deliveries on the exchange platform or take the deliveries as per their inherent interest for the commodity. And in terms of quality specification also, there are good degree of say stringent parameters as well as good robust settlement process that exchange has led up in order to ensure that whatever deliveries are tendered on the exchange are matching to the contract parameters, and there is a good amount of quality testing as well as assaying which is done at the time of deposit, and in order to ensure that the right quality is delivered from the exchange system. And in terms of kapas, it's a raw cotton contract, and basically again, there are only 3 contract months which are available in the month for the year, and basically the price quotation is again in rupees per 20 kgs, and again it's a raw cotton contract for the Shankar variety with a basis 29 mm and minimum outturn of 34 and maximum trash content of 3%. So in terms of the delivery process, as well as the way the market participant can use the exchange platform for manage the price risk, as well as utilize the exchange platform for undertaking the physical deliveries of the good. As I mentioned that we have already undertaken a series of changes, as well as created that ecosystem to facilitate right deliveries, as well as ensuring that the trade participants are able to use the exchange platform for tendering physical deliveries as per their requirement in order to when they are not able to get the right prices in the physical market, the sellers can use the exchange platform to deliver, or buyers can also use the platform at the same time in case they are not able to find the right quality in the physical market. So in a way, the exchange can help both buyers as well as sellers in order to help mitigate their price risk, as well as also help them to cover for physicals in case they are finding it difficult to get the right set of quality from the physical markets. As I mentioned, this cotton contract was available on the exchange since almost last 1 decade, and we have seen a good degree of participation as well as growth. We have handled total deliverable quantity as high as almost 3 lakh bales on the exchange platform, and on year-to-year basis, we have seen that the contract has got a good participation as well as traction from all set of cotton value chain participants. In terms of the recent changes that exchange has done in order to boost the confidence as well as the participation on the exchange platform, we have taken a series of changes in order to ensure the right set of quality that is delivered on the exchange platform. We have appointed independent sampling agency of repute like SGS in order to handle all the assaying which is done on the exchange platform. We have also done a lot of changes pertaining to the shelf life, as well as the standard deduction which is applicable for the deposit which is kept on the exchange warehouse, and also introduce a concept called moisture adjusted weight, so that the buyers on the exchange platform can be given the right set of weight in compensation to the moisture gain or loss as may be there during the storage period of the commodity. So I would also like to bring into the fact that this derivative trading is slightly risky, and I would like to request all the market participants that they should use their own wisdom as well as their proper understanding to trade in the commodities. And they should do all the due diligence which is required before initiating any trade. They should understand what is the contract specification, as well as they should know all the risk that is there in terms of the financial risk, as well as the market risk that they face while doing a trade in the derivative contracts. So they can anytime visit the MCX website. We have a plethora of information which is available on our website, which helps the market participant in order to understand the contract specification, as well as how they can use the exchange platform for their own use in terms of managing the price risk, as well as in terms of using the platform for physical deliveries. I would also like to stress on the point that all the participants should do a proper due diligence while selecting the market participant through which they are going to trade. I think Rajni has already highlighted the fact that she is one of the empaneled members for the exchange. So similarly, there are other members also which are present. So you can use any of the facility from any of the members for undertaking the trade. Before doing that process, one has to do a proper KYC disclosure to the members as well as to the exchange, so that the entire records can be documented prior to registration as a client. And once that is done, a unique client code is generated through which the market participant can, through that particular UCC, you can ensure that all your trades are done in your record. And one should also do a proper reading as well as understanding of the risk disclosure document, as well as rights and obligations of the investors, which is also present on our website, so that they are aware of all the risk as well as the other statutory requirement which is required from the trading participant. And there are also a host of don'ts or the mainly the what to say, red flags, which is already pointed out by our market regulator SEBI, as well as exchange also time and again points out these particular red flags through various communication, that one should not get influenced by any indicative returns or very attractive returns which are offered by fly-by-night operators. One should not get lured away by false advertisement as well as rumors which are prevalent in the market, and one should do a proper due diligence before undertaking any trade on the exchange platform. Yeah, that's it.
Thank you, Abhishek, for a very good presentation. You talked about what MCX does in the derivatives market, but I want to kind of underline once again what you said in the latter part, concluding part of what you said on cautioning market participants. Extremely important. While those with exposure to the physical market, physical say cotton market, whether as a primary producer or as a ginning pressing factory or a spinning mill or textile mill, exporter, importer, trader, they all have to hedge their price risk because markets prices are very, very volatile. Therefore, it is important for all of them to secure their prices and secure their profits. Otherwise, the profits will be eroded because of price volatility. That's one. That's the hedging part. But what you spoke about the financial investment, this market, this contract also lends itself to investment, not just for hedging, but it can also become a tool for investment. Here, the point simply is that those who want to make financial investment in such derivative contracts, I would strongly urge, strongly recommend that if you are a financial investor, if you want to be a financial investor, you must have adequate product knowledge and market knowledge. Please first study the commodity, the fundamentals of these commodities, any commodity for that matter, and track this commodity. Look at how prices change. While you will know how prices have changed, what is important is you should know why prices have changed the way they did. Okay, so that's the kind of knowledge that you need to give, product knowledge and market knowledge. And the investment in this commodity, or any commodity for that matter, will have to be, you need to have adequate commercial intelligence and research capacity, not just because somebody recommended and you started to invest. Therefore, I think it is a great investment tool, there is no doubt at all. But unlike equity market, in the equity market, the usual direction is only one-sided. The market goes up and up and up, primarily because India is in an expansionary phase, and therefore even if you invest in the index, index will keep going up. Of course, there will be correction from time to time, but over years it'll keep rising. But while equities are investment asset class, commodities are consumption asset class. So commodities are for consumption. There you have price volatility. Therefore, those with stake in the physical goods will have to manage their prices. Yet it is also an investment opportunity, but the price movement will not be unidirectional. Prices will keep going up and down. We have seen, and therefore, for the investors to benefit from the price volatility and price fluctuation, they need enough product knowledge and market knowledge. They should know the dynamics of the market. They should know what the drivers of the market are, etc. And therefore, a part of these exercise, a part of what we are doing now is to share our thoughts about the drivers and dynamics of the market. What Jagan said earlier about how, what are his thoughts about the markets and the fundamentals, what Rajni pointed out are all great inputs. The market participants will have to absorb these inputs, then do their own research and come to their own conclusion. Number one. Number two, all these numbers may sound quite daunting to start with for a fresher, for a newcomer. Those already in cotton business will understand what this communication is. But for newcomers, these numbers and the jargon will be quite daunting. But it is actually not as daunting as it appears to be, because you need to get used to this jargon. You need to get used to the commodity market dynamics and drivers. Over a period of time, you will acquire enough knowledge, and that knowledge is what will help you. So don't get carried away. Start your own research. Look at cotton, where it is grown, where it is consumed, what is the supply chain, what are the drivers of the market, how have prices changed in the say last 2-3 years, how and what caused the price changes, how are government policies responsible for price movement, etc. Actually, that's a very different education program which I run on the drivers of commodity markets, etc. But maybe some other time we'll do all that. But excellent. I think we are probably coming to the concluding part of this webinar. I just want to check. I think Rajni has left. She had something else. She called me. She had to leave, and that was okay. Jagan, any closing remarks that you have in mind which you might have missed out? Is there anything you want to say? Jagan?
Yes,
Yeah.
sir. Actually, it was muted. Sorry.
Yeah.
No, so I was listening attentively to what Abhishek was presenting, and then the concluding comments from you, sir. I perfectly agree with that. I think, commodities as such, it's a great opportunity for anyone on the hedging side that you want to protect the risk, your company from getting exposed to risk. It's a great tool. For somebody who wants to multiply their wealth in a very, you can take advantage of the leverage that is provided by the futures market. 100 रुपए के लिए आपको पूरा 100 रुपया नहीं लगाना पड़ता है. जो भी मार्जिन मनी है उसके साथ आप यूज करके you can leverage, you can multiply your wealth and do that within defined limits. Before you put up your money upfront, you should be very clear that I am willing to lose only this much. Yeah, so with that discipline, if one approaches this, I think it's a great tool, and I personally would want to see MCX really picking up, because unfortunately, compared to China, which has ZC futures, compared to global audience, which has an ICE, unfortunately in India, MCX is the only tool available to us. But because in general, the Indian investor community really doesn't relate to, what exactly is futures and options market. Kabhi, we are not able to grow it up to a scale where it can become a very useful hedging tool. So, ये country का development के लिए भी ये important है.
बिल्कुल. It needs also very strategic communication with the target audience, the target participant. For example, mutual funds, as an example. We need to have strategic communication. I think we are actually now racing against time. I I'm not sure if we have the time to take questions. One sec, let me look at the chat box. Oh, Jesus. Is it okay if we go into good afternoon, I'm interested, palm oil trading and import. Gautam Kumar, thank you. I think we are, you may, I'm interested in palm oil trading and import. I'm afraid that this is not the forum where I think you should actually talk to some broker. Maybe you should talk to Rajini. She will be able to guide you better. Dr. Goyal says, in spite of, why am I not able to move? In spite of too much talk of farmers' participation in commodity market and get benefited by it, their presence is negligible. Any roadmap to accelerate it? Yes. Any projection against total 120 million? Right. Dr. Saab, absolutely valid point. But we must remember, even in the United States, farmers don't hedge directly. Farmers look at seaboard prices, whether it's corn or soybean. A farmer, they look at seaboard prices and then they negotiate with elevator companies. And in India, farmers are small, marginal. Therefore, it's not possible for individual farmers to hedge their price risk. And I've discussed all this in so many times in SEBI and even with FMC. But it's fashionable to say always that farmers should be allowed to hedge. Nobody stops them from hedging, but we need to educate. But that's not going to happen. Let's be honest. What is likely, what we should be doing is educate farmer producer companies. Farmer producer companies are a great collective, and therefore they should, for example, MCX should engage with FPOs and educate them and bring them on board to trade their prices, cotton based FPOs, for example. I think that is one way forward, which is important.
Just to add to your point, we have done or we have engaged with many FPOs, particularly for the cotton.
Yeah.
And most, I think 2 or 3 of them are in process of initiating their trade based on the exposure in the physical market, and we are doing a lot of awareness activity along with the farmers through the FPO route in order to create that level of understanding as well as awareness for the cotton derivatives.
Yeah, correct. Someone from Vietnam, greeting from Vietnam National Plant, Gene Bank, Hanoi is keen, so a principal investor. It's a pleasure to join this event. Okay, we could consider to develop Asian value chains, development of grains. Okay, all that. We will have a look at this link. I must mention here that I was a speaker yesterday at the International Cotton Advisory Committee meeting. Abhishek was there. I'm not sure if Jagan was present.
Jagan sir was also there.
Yeah. Okay. Sorry, we didn't meet. Or anyway, that is okay. I have actually proposed a big thought, big idea, which is that 70 to 80% of cotton production, cotton consumption, cotton trade happens within Asia. Why should cotton prices be determined in ICE in the United States? All Asian producers and consumers should come together and form what I propose as a Asia Cotton Alliance. Okay, I think it's a big thought. It can be taken forward. So our friend from Hanoi, this is something which we can think about. And therefore, okay, we'll take it. Nice to hear. Okay, why are cotton contracts still muted? Dr. Saab, you should know any move by SEBI to redefine contract. We have done it. We did it in 22 and 23. The trade association, there is a advisory committee, and I was a part of the advisory committee, recommended several changes. These changes were carried out, yet the trade associations and the traders who wanted revision in the contract terms have not come forward to trade. So there is what should I say? There is a certain reluctance to trade. And why is there that reluctance? What is preventing them is something they need to tell us. You can't keep blaming the contract. After all, a contract and the price that a contract throws up is only a messenger. It gives you a message. Therefore, I think the value chain participants have a big responsibility to ensure the success of MCX or any exchanges contract. If they have any reservations, it should be voiced. But somehow the trade participants, value chain participants seem to be comfortable in not hedging on a large scale. So I think we need to do a lot more introspection. But there is nothing which SEBI can do, because finally promotion of contract is with the exchange. It is for the exchange to promote it among value chain participants. Okay, any so what is the next question is update on China offloading cotton from state reserves. Any thoughts, Jagan, on this? China usually creates a reserve and it usually also offloads when prices are high.
I think he has already responded in the chat.
Any thoughts on this?
So he has already responded on the chat that there is, basically China has already completed the sale of cotton from its reserve.
All right. Okay. Yeah, Joe is responded. I didn't see that. Kishore Tanna, I need to. Okay, Kishore is left. Okay, all right. I think we have come to the end of this. I want to thank all the participants. Thank you very much for being patient. I want to thank my co-panelists, Rajini, who is left, Jagan for his wonderful speech, Abhishek, thank you very much. I want to thank IMC team, Bharti, who's done a fantastic job for the first time. It is her first time. And of course, the IT team of IMC has done tremendous work. So I want to thank everybody. I'm beholden to our very senior friends like Goyal Saab for participating in this. So with this, we will conclude today's event. We will keep doing these events probably with MCX every 2 months or even in greater frequency. And possibly, Abhishek, now I think we should stop with 23, stop these online events and do in-person events. That is what will be more effective, more telling. It will connect. That is what creates a certain bonding, a certain credibility. People want to see who's speaking in person.
Surely, sir. We would like to visit also to the actual trading and consumption center, so that we would also like to be in the heart of the trading and consumption center of the cotton, so that we can explain them.
Let us sit down and start planning.
Sure.
And start planning. So online, it was 2020 and 21 and 22 COVID movement restriction. It was okay. It was appropriate. But I think we should now phase it out in my view. But think about it. So let us conclude this event. Good luck. God bless you all. Stay safe, and we will catch up soon. You will hear about our next event. Thank you very much.
Thank you so much.